Okay, good morning, everyone. Welcome to the National Press Club. I'm Kimberly Micus, a member of the National Press Club Newsmakers Committee and the host of today's Newsmaker featuring Congressman Barney Frank. Before we begin, I'd like to remind you again to please ensure that all cell phones are off or silenced. We have other interesting upcoming events occurring at the Press Club, including luncheons featuring Ted Leonesis, which is on Wednesday, and Congressman Michelle Bachmann, which is at the end of the month. As well as a briefing on the humanitarian situation in Libya. Please check our website's calendar for dates and times as well as other events. Our guest will speak for approximately half an hour, and afterwards we will take questions from the audience. The Press Club gives preference to members of the media during this time. When asking a question, please identify yourself and the agency or organization you represent before asking the question. Please keep questions brief and to the point so we are able to get in as many questions as possible. After the press has finished asking their questions, other audience members are welcome to ask theirs. Congressman Barney Frank represents the 4th Congressional District of Massachusetts, and he is also the ranking member of the House Financial Services Committee. Last year, he helped pass the Dodd-Frank Wall Street Reform and Consumer Protection Act. Welcome, Congressman Frank.
Thank you. And that reference to my colleague, Michelle Bachmann, reminds me that those of you who cover the Financial Services Committee might ask your editors for dual pay, because you will also be covering the Republican presidential campaign, because I think for the first time in history, 3 declared Republican presidential candidates sit on the Financial Services Committee: Ron Paul, Thaddeus McCotter, and Michelle Bachmann. So I'm going to talk to the Capitol Police. I hope people won't need to get by the Secret Service to get to our committee business, but I don't think we've ever had 3 declared congressional presidential candidates on one congressional committee before. Anyway, on the financial reform bill, and I wanted to do this because it is a year, and we, I think, are in a position to make some judgments about this. I want to begin by saying that I believe that the years study, examination, criticism, advocacy, etc., leaves this legislation holding up very well. The Republicans have had a number of hearings, and there have been very few calls for any substantial amendment on the part of the Financial Services Committee. In fact, one of the things that I thought quite inappropriately people were pointing as a criticism is, as we knew it would be a strength, and that is the fact that what the bill does in many cases is to set forth some very important principles, but gives the regulators the ability to apply them in practice. Now, there are 2 reasons for that. First of all, you cannot in 2010 decide for the indefinite future what certain specific numbers ought to be, capital ratios, etc. Secondly, to the extent when you legislate that you get very specific, you are inviting the people about whom you are legislating to evade what you did. The more specific, the harder. And as a matter of fact, you will remember for many years, people in the financial community were telling us to be more like England, where they did principles and not rules. We do think we need rules, but you cannot legislate some of these very important questions. And as people have come before the committee, they have talked about, for example, with regard to taking into account international competitive factors with regard to imposing margin on end users when we were talking about an American subsidiary based in a foreign country dealing with a non-American customer. The regulators have the flexibility to deal with that. The Volcker rule, which many in the banking community obviously didn't like, but they have acknowledged that the way it was written, the regulators have a flexibility to apply it in a way that we think does the good without doing the harm. And that's true in a number of other areas. So I think that's a factor. There is the only issue where I saw people on the whole in the financial community unhappy in the banks was the amendment sponsored by former Senator Lincoln to push derivatives out of the bank. I always felt that it was more important to have rules for derivatives wherever they were. But even that, obviously, the banks don't like it, some others do. But I am struck, at least in public, at how little advocacy there has been for very substantial change. I also think that things are moving well in the international front. When I was about to become chairman of this committee in 2006, we were being told that we had to cut back substantially on American regulation because everybody would go to more welcoming jurisdictions. The Financial Services Authority, with their, quote, light touch, unquote, regulation was advocated. About a year and a half later, Adair Turner, who was the chairman of it, said the era of light touch regulation is over. And in fact, we no longer have that. And I think America is in the lead in pushing for an international set of standards which are better. And some of our friends in Europe understand that now because there were European countries, Germany, for example, where people didn't make subprime loans, their financial institutions. They just went bankrupt because other people did, mainly in America, because there is a degree of interconnection. By the way, an aside, not directly relevant to here except to how we got here, we're told, obviously, in 2008 by the Bush appointees, Ben Bernanke, Hank Paulson, and others, that we were facing something as bad as the Great Depression. I think in many ways it could have been worse than the Great Depression, because 80 years ago, you had there was a granularity to the economy. Things could be going very bad in one place, but they could be going well elsewhere. There was more of a localism to it. By now, everything's interconnected. And when things bog down one place, they bog down another. That's a powerful argument. So you're not going to get the same, and even over the last few years, people have seen this. Some of our European allies or friendly competitors underwent such turmoil themselves in the last few years, and in many cases are worse off than we are today because we have dealt with this stuff more forthrightly, I think, in some ways. You no longer have this, let's have people come over here. And as a matter of fact, many of the European institutions are complaining loudly to their regulators that America is nicer, for example, in compensation. And while there are some legitimate issues that have to be addressed, and as I said, on imposing margin requirements on end users in other countries, some of the financial institutions sometimes sound like the 14-year-old child of divorced parents trying to play mommy against daddy. And if you don't let me stay up late, I'm moving over there. And the regulators have been talking, and I do not think we see at this point any serious problems. And that includes a capital surcharge for systemically important financial institutions. And in fact, one of the things that's emerged, there's been this debate about did we end too big to fail. It's now clear that we did. And in fact, when the Republicans had the hearing on international competition, two industry witnesses, one representing a bank organization and one Hal Scott from Harvard, who's been a supporter of a strong role for the financial industry and skeptical of some regulation, the Committee on Capital Markets, both noted that there was a potential competitive disadvantage for large American financial institutions because we are so firm in not allowing bailouts. And they noted that America has by far the strongest anti-public participation in bailout law and rules in the world, and that this could be a problem for American institutions vis-a-vis others. The argument, by the way, that being designated as a systemically important financial institution somehow confers an advantage on you because you'll be able to borrow more cheaply. This is, we have heard of the gift that keeps on giving. This is the gift that people keep on refusing because unanimously, any institution about which there is any discretion as to whether or not it is designated as systemically important has vehemently asked not to be. Again, the notion that this somehow gives you a benefit, apparently all these people have suddenly become very self-sacrificing. I was hoping we can get them to neutral, but now apparently they're giving giveaway. And the fact is that overwhelmingly people do not want to be designated because of what it carries. I will say, and I've said this before, I've pointed this out to Governor Trujillo of the Federal Reserve, to the extent that he talks about adding an element to the charge for systemically important financial institutions to offset any advantage they might get from being perceived as too big to fail, he's mistaken. The way to deal with that is to help us get rid of that perception. And as you know, one of the rating agencies has already moved in that direction. But it is overwhelming. And in fact, a couple of the businesses have noted America, at this point, actually Lehman Brothers, not something that was done deliberately, but they say that's the only example of a major financial institution in a developed country being allowed to totally fail with nothing. So that one, the evidence clearly puts to rest this notion that we didn't deal with too big to fail. there are a couple of areas where I see the attack coming. First of all, it is interesting that my Republican colleagues, unlike climate change and health care, don't want to take this one on head on because it is still too popular. As I said, the coming to the defense of unrestricted derivative trading is not a popular cause. So they're coming at it in sideways. One is to try to use the deficit as an excuse for underfunding the SEC and the CFTC. The CFTC is being denied the funds that it needs that are a small percentage of what we're wasting trying to build infrastructure in Afghanistan. The notion that the CFTC, that the $80 or $90 million more that we need for the CFTC can't be done because of the deficit, when people voted to send $147 million to subsidize Brazilian cotton farmers so we can keep subsidizing American cotton farmers, is nonsense. Similarly with the SEC, which they want to turn into a profit center. The SEC will bring in more money through its regulatory system than it will be given to run it. So that's one negative effect. And in fact, what you have running here is a catch-22. First, deny the SEC and the CFTC adequate funding. They, in turn, are not able to deal with the rulemaking requirements that they have. And then, because they haven't been able to move as quickly on the rules, announce that clearly the rules have to be abolished. But that's something that they have imposed. Obviously, you want the SEC and the CFTC to have very smart people and very good information technology. I have to say here, I do not see this coming from the financial institutions. I think many of them recognize, as does, for example, the pharmaceutical industry, that while you may not like the rules in the first place, if you've got the rules, you want them well run. And I have not seen this. This is coming from the ideologues in the Republican Party who just believe, despite all the evidence to the contrary, that an unregulated free market works. And you saw this in Alan Greenspan's article in the Financial Times. It's as if the last few years never happened. The other problem we have, and I have to be honest, is I have been disappointed at the pace of appointments from the Obama administration. We knew last August that a controller of the currency needed to be reappointed, and they have only now come up with a good bipartisan appointment in Tom Curry. I regret the failure still to appoint someone to the CFPB. On the other hand, there have been cases where they have made good appointments. Joe Smith from North Carolina, a bipartisan bank commissioner in North Carolina, brutally rejected, I mean brutally, according to Joe Smith, treated like he was a disrespectable person by the Senate Republicans, and announced that they will confirm nobody to the CFPB unless we undermine the very purpose of the CFPB. The purpose of it was to give them independence from the bank regulators, and now they want to subject them to the bank regulators before they will nominate anybody. And that is an absolute perversion of the Constitution. There is the legislative power, in which you make laws, and there is the confirmation power. And announcing that you will not use the confirmation power until you get, by that extortion, what you can't get through the legislative process, is a perversion of the Constitution. And there's one final area that I am troubled by. And here I have to say some of my liberal friends are part of the problem. The single biggest cause of all this was the ability of people to make mortgage loans with neither regulation nor risk. Now, we have dealt with that in substantial part. And banks, particularly the community banks, get justifiably unhappy when people talk about how the banks cause this problem. Because if only those institutions technically known as banks, deposit-taking institutions which get deposit insurance and are therefore subject to regulation, if only they had made mortgage loans, we would not have had the crisis we had. Part of the problem was that a couple of things grew up. Great sources of liquidity outside of the deposits, an information technology revolution that allowed institutions that were essentially unregulated to make mortgage loans. And you had the worst of both worlds in some cases, because what you had was some banks were able to set up subsidiaries that were not subject to the full regulation that banks are subjected to, but because they were affiliates of national banks and because of what the control of the currency did in 2004, they weren't subject to state regulation either. You created a great kind of vacuum. And that, by the way, was a bipartisan mistake, because it was a Clinton appointee, Jerry Hawk, who was the holdover appointee, he had a term as control of the currency, who in 2004 greatly over-preempted. And we see the current controller trying to maintain that in direct contradiction to what the bill says. And that's one of these things that has to be corrected. But the problem was that people were able to make loans without regulation, as I said, without risk. Now, we've solved part of that problem under the legislation, the Consumer Financial Protection Bureau has jurisdiction now over activity. And that's one of the things we try to do in the bill, is to regulate activity, not institutions. Because if you regulate by institution, an institution can change its shirt and avoid regulation, go shopping for different regulators. What you now have is a regulation by activity, whether it's derivatives or whether it's mortgages. And the CFPB will now have rules for all mortgages. And it has some substantive rules for all mortgages. So we have dealt with that. But there was a second part of it, and I believe that will be well done. And they have the ability to put servicing requirements in going forward. It's very hard to undo the mess we have now with servicing retroactively, but we can, and I believe the CFPB will prevent that from happening again. But there was another aspect to it. With the best set of rules in the world, if people don't have an incentive only to make good mortgages, i.e. mortgages that can be repaid, you're going to have trouble. That's why risk retention was so important. Now, I am troubled because there is an assault now on risk retention. And I agree that a 20% requirement for a qualified residential mortgage is higher than it has to be. But unfortunately, and some of my friends in the advocacy groups are involved in this, there is a subtle shift here in which people have stopped objecting to what's involved in the qualified residential mortgage as an exception and have instead tried to claim it should be the rule. There is a general notion that risk retention in mortgages really is too burdensome, and that the combination of the rules and risk retention will mean you can't get mortgages. I just was rereading Lou Ranieri's testimony before the Senate in which this was created. Ranieri has been subsequently critical of the way in which some of this has happened. But his testimony in favor of legislation to allow securitization to go forward is in 1986. So if you listen to these people, you got to wonder, how do we ever get any mortgages made before 1986? If securitization is essential to mortgages and risk retention ruins securitization, what the hell are all these people living in before 1986? I will acknowledge what we're trying to do with derivatives, putting them into clearinghouses and exchanges and requiring margin when the financial institutions deal with each other, when AIG and Goldman Sachs deal with each other. Yeah, we don't think they should be allowed to do the way they did before. Risk retention in mortgages, these things are disruptive. That's really what you're hearing. Well, we haven't done it this way. It's going to be harder. It might cost us a little more. It's disruptive. Yes, it's disruptive because we had to disrupt a rotten system. We had to disrupt a system which collapsed. And it collapsed because risk was made to appear to disappear. People were able to engage in activity in which they did not have any risk. But risk didn't go away. It just accumulated elsewhere, and then it exploded and rained on all of us and caused a terrible problem. Risk retention is a very important piece of this. I was arguing with some of the people in the mortgage bankers, and they showed me their view, and they say, yes, we like risk retention. But if you read their paper, they really don't like risk retention very much. For example, they want to be able to sell securities that include some that meet the qualified residential mortgage test and some that don't, and not have risk retention. They want risk retention to last only 5 years on 30-year mortgage packages. This assault on risk retention is a terrible idea. And now, and here's the, let me just read a summary of what people say about this. Here's, no one disputes there were lending excesses during this decade's housing revels. But here's what people are complaining about. Forbidding banks from signing up borrowers for overly expensive loans, requiring banks to make sure that the consumer has, quote, a reasonable ability to repay the loan, and the loans be, quote, overly expensive loans are banned. Also, requiring that banks that securitize mortgages be made explicitly liable for violations of the lending laws. And here's what we're told about this set of regulations, which include risk retention requirements and specific bans on types of mortgages. For all the demonizing, about 80% of even subprime loans are being repaid on time, and another 10% are only 30 days behind. Most of these new homeowners are low-income families, often minorities, who otherwise would not have qualified for a mortgage. In the name of consumer protection, Mr. Frank's legislation ensures that far fewer of these loans are issued in the future. This would also hit banks when their shareholders are always being punished. the bill couldn't come at the worst time. It will shrink credit to marginal borrowers, which will mean fewer borrowers. This bill is a Sarbanes-Oxley for housing. I'm reading you from a Wall Street Journal editorial from November of 2007. They were talking about how wonderful the subprime loans were performing in November 2007. This is having the Wall Street Journal criticize others for allowing subprime loans. It's kind of like their sister publication, The News of the World, accusing people of not being respectful of others' privacy. The fact is that these criticisms the Wall Street Journal made back then are unfortunately being repeated now. And there is an overwhelming consensus that securitization without risk retention, which will never go down with taxation without representation as a slogan. I understand that. Even with people whose diction is better than mine, it ain't going to work. But there's a consensus it's a problem. Read Michael Lewis in The Big Short. And again, it is very clear that it was the ability to make risk appear to disappear, to get it out of your sight. Read Julian Tett in Fool's Gold. The solution to that puzzle came by linking derivatives technology to a technique known as securitization. Michael Lewis, the same thing. The Economist, talking about the dangers that might be in exchange-traded funds, says, this has echoes of the subprime housing crisis in which financial innovation went out of control. It had its origins in invention with a benign name. This is just a couple weeks ago. The packaging of mortgages for use as securities for bonds was intended to reduce borrowing costs and disperse risk. Eventually, that transmuted into complex collateralized debt obligations and lower lending standards. And as I said, some of my liberal friends are joining in, so I want to make a few things clear. Qualified residential mortgages not subject to risk retention, are to be an exception, not the rule. The notion that you cannot have mortgages without securitization, and you can't have securitization if you have risk retention, is clearly wrong. First of all, before 1986, we didn't have securitization. Let's understand that. And we had a pretty healthy housing market in America. But secondly, and I agree, securitization is a very important tool. But the notion that people who are making these loans should retain a 5% interest in the loans as a guarantee against them making loans that don't have a chance to be repaid, that's an impediment, as the mortgage banker said, this would impede the loans. If it is, then we have a serious problem to the kind of loans we're making. And I've been told by some, well, it's a problem if you have two kinds of loans, a bifurcated market, some which is subject to risk retention and some that aren't, that'll be bad. Fine, if they really believe that, then let's do away with those without risk retention. The notion that holding 5% of the loans, before 1986, you held 100%. And I remember, again, being told by some of those who made the riskiest loans, you'll drive us out of business. We can't do that. Why? Asked why is 5% so much of a problem? Well, we don't have any capital. Well, if you don't have any capital, don't lend it. Don't lend money you don't have. And again, it's like the Wall Street Journal editorial. Here's the Wall Street Journal editorial again. These subprime loans are wonderful. You're going to drive low-income people out of the market. I run into again what I ran into for much of this decade and before. The notion that for many people in the lower income brackets, rental housing, decent rental housing, is preferable to putting them in a home ownership situation which is precarious. It's a hard one to overcome. By the way, on home ownership, and I work on it, it's one area of the bill that I think may need some work, and that I believe manufactured housing continues to be a very important thing that we have begun improvements on that, and I hope to continue them. But it's interesting that you have assaults on the bill now. You have the funding ones. Well, people understand those, and I think the public will clearly fight back against those. You have this effort to undermine the rules on derivatives. My Republican colleagues have legislation that passed both the Agriculture and Financial Services Committee to postpone any new derivative regulation, including speculation, until October of 2012. Recently, several publications noted the fear that American financial institutions have sold credit default swaps on Greek debt, and we have a degree in the tens of billions or hundreds of billions of liability nobody knows about. And we don't know how much that is because the bill hasn't yet gone into effect, and people are still trying to postpone it even further. And that uncertainty is in and of itself a problem. We have speculation. Look, the spokesman for the Republicans on this has been Jack Kingston from the Appropriations Subcommittee on Agriculture. And he has clearly said on the floor of the House a couple of times, speculation has no impact on energy prices. By the way, there was a big argument about that among economists, and 20 years ago, it was a tougher argument to make. What's happened is information technology, greatly increased liquidity, I think, have transformed that. And there is now a consensus within the financial, if you read the financial pages, people talk about the impact of speculation. It's a given. And the Republicans are trying to keep the CFTC from doing anything about speculation. Those are the head-on attacks we have. There is, though, this more subtle one, this attack on risk retention. And I believe that risk retention is the single most important piece of this bill. By the way, you know, of course, the response when we used to say there was a problem, you know what was supposed to be the substitute for risk retention? The rating agencies. The rating agencies were the ones. You didn't need to have the lender worry about this because you could go ask the rating agencies. The Oracle of Delphi. Now, of course, the rating agencies are trying to overdo it. The people who told us that subprime loans were good are now telling us that the sovereign debt of Portugal backed by the European Union is not good. I think they were wrong both times. But that's one of the things that I really want to particularly address now. And it does involve me in an argument again with my liberal friends. Yes, 20% is too high. But if I read the mortgage bankers, they don't like a down payment requirement. They are against the debt-to-income ratio, and they are against the loan-to-value ratio. But they say we should find out how much money the people are making to whom we make the loans. Why? If it's not relevant what the ratio of that income is to the debt, the value of the home isn't relevant, they don't have to put down any down payment, and you're securitizing 100% of the risk. So what? So, yeah, it is important that we do substantive what we did. I don't want to say that risk retention is the only thing. We've made a substantive change. You know, we ignored the Wall Street Journal's editorial in 2007 because the bill that they were opposing then, which passed the House but not the Senate at that point, was incorporated into the bill. And their fears that subprime mortgages won't be given, I hope they turn out to be accurate in that for once. But on the question of risk retention, you can give good, we now have no unregulated mortgage lenders, and we have banned a lot of the bad practices, and they're going to be subjected to regulation. But particularly those conservatives who point out correctly that regulation can never completely replace the market shouldn't be advocating that we do away with the one market-based incentive that is so important here, and that is risk retention. Risk retention is a market-based incentive. It says to the person, put your money on the line and everything will be okay. And that's why I intend to talk more and more in disagreement with some of my liberal friends. Again, not at 20%, but I do think there needs to be a down payment requirement and some of these other factors. And risk retention, loans made without risk retention should be an exception and not the rule. And if people are convinced that you cannot have a bifurcated market, then I am for doing away with the exception, not the rule. With that, I'll be glad to respond if there are any questions or comments. Yeah.
You know, we in the media love anniversaries, and with the one-year anniversary of this bill's passage coming up, what would you say are the three most important outcomes from your perspective, the best things that came out of this legislation?
Okay, I got to say, I'm always puzzled by the three most or the single most, because nobody ever lives his or her life that way until I'm asked by the media. Was that Sophie's choice? Is that you're always asking us to make? I will say there are several important pieces. I think I've just touched on them. Risk retention, derivatives. But I think it's a combination. It was loans, the loans made without any consideration or without adequate consideration of risk. They were the bullets. The guns were the derivatives, and both sides of the derivatives. The derivatives on the positive side, the credit default swaps on the negative side. Because what happened was we made a bunch of loans that shouldn't have been made, and then we had sophisticated ways of ricocheting them all over the world, and people got hurt by them. So those two were very important. An independent consumer bureau was very important. Now that was important. Those are the two most important systemically. And the Consumer Bureau was important for a part of that because it will have that regulation. In terms of public good, we never said the bill was only to deal with the things that caused the crisis. I think the Consumer Bureau is a very important innovation. Another one is we have ended the bailout situation. And again, the Republicans are trying to, in the face of all evidence, to argue to the contrary. As a matter of fact, I'm going to be following up on this. The acting control of the currency in the speech he gave that caused some controversy, one of the most controversial things, I don't think got a lot of attention. I was reading it on the plane yesterday. I was a little bit behind. He kind of complains about the fact that we're not going to have publicly funded bailouts. He says in the next to last page of the speech, you know, we need a banking system, and there has to be a safety net, and the public should be willing to pay for that. That sounds like putting us back in their business. We've had other people complaining some of the testimony that, and a former Treasury aide just wrote an article complaining that we took away the Federal Reserve's power under Section 13.3 to do what it did with AIG. When we made it illegal to spend money, public money, to take care of a financial institution. We can spend some money to pay off some of its debts if that's necessary, to be recovered from other financial institutions, but none of it goes to shareholder. You saw what the FDIC just did in terms of a clawback. I think that was very important too. Yeah.
Oh, please excuse
I'm sorry, you're in charge of that. I apologize.
No worries, sir. I just wanted to remind you to state your name and your organization before you ask the
Well, it's
question.
better you do it. Let them get mad at you.
That's fine.
Sam Husseini Institute for Public Access, IPA Media, actually. Mr. Frank, how is it that even after Dodd-Frank passed, American financial authorities are frankly confessing that they don't know the exposure American financial houses have to the possible collapse of major European banks?
Because the law hasn't gone fully into effect yet.
Sorry?
The law has not yet gone fully into effect. That's exactly right. I mean, we passed the law a year ago. There are rulemaking. You don't go just like that. These things have to be phased in, and that's part of what I talked about, the denial of funds to the CFTC and the SEC.
And when will that happen?
Within the next few months. But that's precisely what I was talking about. It was
Alluded to it.
if they had been fully funded in February and March, we'd be a lot further along. That's a large part of the issue. They have got a lot of rules to do, and that is why I did allude to it. And if the Republicans have their way, we won't know before October of 2012. We hope to be able to get that within the next couple of months. But that's precisely what the bill will do once it's fully in effect.
Okay, let's get somebody over here. Go ahead.
On the GSE loan limits, Alan Zibble with Dow Jones.
Thank you.
What's your position on, should the GSE loan limits be extended for?
Absolutely. I think in the first place, it's a matter of fairness. The people I represent in Massachusetts bear the same share of the burden for whatever financial cost there is. But if you drop the loan limits, they don't get very much of the benefit. The most variable price in America is the housing price. And to have no recognition in federal policy of variations in housing price makes no sense. I mean, yes, we want to ban luxury housing, but if you don't have loan limits that pay attention to median house prices, then you don't get it. And
How long should the extension?
forever. I'm making the equity argument. Now, there's a second argument that this is a bad time from the stimulus standpoint. Secretary of the Treasury was just saying exactly that. It's interesting. I know there were some stories in some of the media a while ago about, isn't it terrible? People can get houses at such and such a price. People talk about 700,000, of which there are like 30 counties in America that reach that limit. And now the stories are how terrible it'll be that they don't have it. It's kind of like, there's no right answer. But this is a very bad time to be cutting back on housing. But the basic point I want to make is the equity argument. I mean, to treat the whole country as if it was one, let's put it this way, if the level is too low in one place, you get an unfairness to those people. And the same level can't be right for the whole country, for San Francisco and Mississippi. The federal government does take into account cost of living in some cases, regional variations, but house prices, again, are the most variant. So it would be it would be especially bad time now economically to do that, but it's also an equity matter.
Zach Morbrot with Argus Media. What hurdles do you think the administration will have in appointing a new commissioner to the CFTC? And should there be a sense of urgency so that person can...
Absolutely. That's another part of the problem with the CFTC. That has to do with speculation. That I believe Mr. Gansler would like to move on position limits, and he doesn't have 3 votes to do it right now. The hurdle he will encounter is the extra constitutional use of the filibuster. the notion that a majority in the Senate needed to pass a bill is 60 is a very recent thing in American history. As a matter of fact, it's an extra constitutional, because if you read the Constitution clearly assumes that majority rule will govern in the Senate. There's a principle that lawyers have that's often misstated. It is the existence of the statement of an exception proves the existence of a rule. People say, oh, the exception proves the rule, which they say if they say something and it's wrong, and then they say that like they weren't wrong, but they were. Because if you say something can't happen and it happens, then it happened. But what this rule is this: if you say something as an exception, that assumes the rule. If you say you can't do something on Sunday, the assumption is you can do it every other day of the week. So if you read the Constitution, there are several places where it says that in the Senate, you need more than a majority. You need two-thirds to convict of an impeachment. You need two-thirds for a treaty. You need two-thirds to ratify a constitutional amendment. The fact that the Constitution says you need two-thirds in those cases means that you need a majority in every other case. Any court interpreting any law would say that. But they have now grafted onto this requirement of 60. And now you have the Republicans announcing that they will use the confirmation power not to say this appointee isn't good or that appointee isn't good, but that we don't like the law, so therefore until you change the law, we're not going to nominate anybody. That may be the problem with the CFTC, in which case I think the president has to use the recess appointment. And for the Republicans who have announced they won't confirm people, like to the CFPB, to object if the president then uses the recess appointment power, it's kind of like a pyromaniac setting a fire and then complaining when people use the fire door. They created the emergency, and the president's got to be able to respond to it.
Dave Clark with Reuters. You say 20% for the QRM is too high. What do you want to see that down to?
I'd say down in the low single numbers, mid-range single numbers. The FHA is 3.5. That's probably a little low. Now, the other thing, too, is I would say there are other factors. There's debt to income, loan to value. There could be a mix. I think you could have a minimum of, say, 4 or 5%, and then take other factors into account. I mean, I understand if it's 4%, some people won't be able to buy houses. That's the problem. The problem is that I'd like to help people with their income, not pretend that they have income they don't have. I mean, we do have a serious problem with income inequality in this country, and we need to address it more. And that's going to be very important to me in terms of how we look at any debt relief deal. But I'd say a minimum of, say, 4 or 5% would be reasonable.
Sheila
This
Barrett
gentleman-
suggested, just a quick follow-up.
Okay.
Sheila Barrett suggested maybe even getting rid of the QRM and just making it all, risk retention apply to all.
That's what I said.
Okay, so you would.
Well, let me repeat.
Getting rid of QRM then?
Let me repeat what I said. There are people who argue that, by the way, the bill that came out of the House originally, the bill of introduced did not have an exception. To have compromises. I thought an exception qua exception was a good idea. But then people, having gotten that, then try to sort of bootstrap it and say, oh, well, but that's a bad idea because there will be a bifurcated market, and that's unfair to poor people if there's a bifurcated market. So my point at this point, I believe we can live with an exception, a genuine exception. But if people are convinced that an exception, a bifurcated market, is deleterious, then I'm for no exception. So in that sense, I would agree with you. I mean, look, I very much agree with her in general, and she's been an important guide to us. I'm prepared to accommodate an exception only as long as it is an exception. And if that can't be done, then we will go back to the way it used to be in America in the deep, dark past of 1984.
This gentleman here to the right.
Mark Sheff with Investment News. What do you think of the Republicans' call, now Republicans in both the House and Senate, for more cost-benefit analyses of Dodd-Frank rules? And as a follow-up, dozens of deadlines for those rules have been missed. How much farther along would we be if the Democrats had kept control of the House?
Oh, much further along because we would have adequately funded them. Look, not all of them would have been done in time. A year ago we approximated it, and we've said as long as they're working on them all, I'm not unhappy that they're taking their time. But if they had been fully funded in January, I mean, if the Democrats had taken control, Frank, I think we would have had a supplemental giving them. And we're talking about maybe $200 million within the context of the wars in Iraq and Afghanistan and all these other things. Not a huge amount of money, particularly since the SEC makes money. And by the way, when people worry about, wonder why we wanted the CFPB not to be subject to the appropriations process, what's happening to the SEC and the CFTC are, of course, exhibits A and B. We would have been much further along. Yeah, I think doing cost-benefit analysis is a good idea. I think you should not hold off on it. I'd like to see some cost-benefit analysis on infrastructure in Afghanistan and some of the other things that they are for. I think it is a reasonable thing to do, as long as the cost includes, of course, the financial crisis of and the terrible lost revenue and jobs and turmoil of I mean, that's the cost. The cost is the terrible crisis we had. Although not at dollar cost. I noticed that Alan Sloan has just come out with a very thorough analysis that's going to be printed in Fortune about how much money we made over the intervention, the combination of the TARP and the Federal Reserve. And Alan Sloan's calculations are that it's made about $100 billion for the federal government.
Gentleman in the back.
Kevin Wack with the American Banker. There's been some criticism of the FSOC for not providing more clarity at this point on identification systems for important financial institutions. I wanted to sort of get your view on that. And just as a related question, you talked about bailouts being over. If Citi were to, go up in flames, are we really to believe that there wouldn't be a bailout given its global?
What do you mean by a bailout? That's very important. First of all, I will not comment on any specific financial institution. Obviously, neither of us have any reason to think Citi's in danger. You gotta, I go in you get to be chairman or even ranking member, and you get more influence, but you got to shut up some. So my first couple weeks, I talk like a normal person, and here I am affecting the market. So obviously, nobody, I don't want to talk about Citi. I will say this: the reason I say bailout is this. If you mean the kind of intervention that kept AIG going, or that kept Bear Stearns alive, had it sold, but preserved a lot of what was involved, no. The law is very clear. If any large financial institution whose demise would have broader consequences fails, that's when the death panels come into place. That institution is dissolved. Its shareholders are wiped out. Its executives are fired, and in fact, as the FDIC just made clear, they might well have to pay back some of their last 2 years of salary. So there is nothing, the institution is over. Then the question will be for the federal officials, if that institution paid none of its debts, would that have effects that reverberated throughout the economy in a negative way? If so, the institution is empowered under the law to pick and choose and pay as little as is necessary to avoid further damage. It's a model the FDIC has been following for some time in banks. It's what Hank Paulson asked for in the spring of 2008, more than 3 years ago. And he predicted, and this was the case, that he had a choice when Lehman and AIG, as he read the law, some people are different, but as he read the law at the time, and he wasn't being contradicted that much at the time, he either paid all the debts or none of the debts. And he said both, they paid none of the debts with Lehman, they paid all the debts with AIG, both were bad situations. So yes, there is an ability on the part of financial institutions, the FDIC, the financial regulators, to make some payment of some of the debts. They can pay part of some of the debts, et cetera. Every penny of which must be recovered by an assessment of large financial institutions. And any federal official, unless there was a change in the statute, who advanced money to keep one of those institutions going would be committing a federal crime. So if you ask me if I think people are prepared to commit federal crimes on behalf of these large financial institutions, no. The other one, of course, was the Federal Reserve, which had the power under Section 13.3 of the Federal Reserve Act to do what it did with AIG. Gone. The fact that we've been criticized, what's going to happen? The Fed is now going to be able to set up a facility for institutions that are solvent but illiquid to come and, if adequately collateralized with the illiquid assets, get some liquidity. But it's got to be a facility that's available to a whole range of institutions. So the answer is yeah, and that's, by the way, what is widely now acknowledged. In fact, some people are saying that's a disadvantage for us. The control of the currency, the acting controller complains about that. He said, well, the public's got to be willing to pay, acknowledging that under our law, the public won't pay. And so no, there will not be any effort to keep a failed institution alive.
And the other part was about the FSOC. And
I haven't heard anybody who really thinks it was a good. The answer is no. I don't think it's a problem. That there's a temporary antsiness. They will get it resolved. I hope the Senate will soon. I'm the president. I was critical they didn't nominate quicker. You know, we worked very hard to make sure that the insurance industry was dealt with in a reasonable way here. The problem was we had, because of the historical accident of McCarran Ferguson, et cetera, no federal regulation, no federal officials concerned with insurance. We worked out a situation. There's been a debate about an optional federal charter. We frankly were able to finesse that and got a solution that was acceptable to the state insurance commissioners, to the large insurance industries, to have a couple of people, including a voting representative on the FSOC from the insurance industry. That's going to be very helpful. And I had myself said until that was done, they shouldn't be going forward. So I think that's very temporary. And I also believe, look, we were very careful in the law. Size alone doesn't do it. The question is volatility and leverage to make you systemically significant. And I repeat again, nobody wants to be systemically significant, except those people who have to be. I think that's a very temporary thing and will be all resolved by the end of the year.
Gentleman there in the gray suit, go ahead.
Oh, me?
Yes.
Yes, Congressman Ted Knudsen with Thompson Reuters Compliment. None of the bills passed by the House Financial Services Committee this year have become law. What do you think has been the impact on financial regulation? Do you think the jawboning has led to weaker regulations?
No. No, I think the biblical provenance is correct as to whose jawbone it is. And I think the impact they've had, unfortunately, has been on the financial situation. They have had an impact by having the SEC and the CFTC underfunded. And that's the serious problem. But nobody has taken that legislation very seriously. In fact, let's just take, with regard to the HAMP. Now, it may have helped in this sense. It may have helped make the program better. We were telling the administration they had to do a better job. But, you know, one of the programs that they specifically tried to repeal, which is one of the ones I'm proudest of, providing assistance to people who are having mortgage problems, not because they made bad mortgage deals, but because they have been unemployed for a long time in this economy. They wanted to repeal that. In fact, that just got implemented. I was very unhappy with HUD. They didn't implement it a while ago. And with a larger foreclosure. So, in fact, if you look at the programs they try to get rid of, they've gotten better and stronger, some of them, since they tried to get rid of them. And no, the only impact they've had is not through the Legislature and Financial Services Committee. The other one, by the way, on the Financial Services Committee is, and we have had a serious psychological phenomenon. Apparently, there are cases where going from the minority to the majority has a severe effect on your memory. Because a year ago, the Republicans knew exactly what to do about Fannie Mae and Freddie Mac. At the conference committee, they offered the Henseling bill. And when we didn't accept the Henseling bill, we said it was not germane. They were furious. And they said, this is crazy. We can't wait. That was over a year ago. Today, we haven't even had a hearing on the Henseling bill. The Republicans knew exactly what to do about Fannie Mae and Freddie Mac when they were in the minority. But gaining the majority has somehow muddled their minds. And we now have 4 Republican approaches to Fannie Mae and Freddie Mac. We have the Garrett's now up to 15 separate bills. We have the Henseling bill that has not had any hearing or action. We have Gary Miller's bill and we have John Campbell's bill. And in fact, I think the committee has been pretty ineffective.
Yes, Ms.
Victoria McBain with the Wall Street Journal. Right now, you know, House Republicans only have one chamber. Are you concerned that the 2012 election could make these not serious bills more of a threat to the law?
No, because I don't think that they're going to win the House, the Senate, and the presidency in 2012. And you also would need they would need to get the White House. And I don't think so. Plus, I also believe they are more ready to do this. This is, again, a case, they're not in the minority in the House, but that goes to this question. I think they're bluffing. I don't think they are ready to pass a law that says the CFTC can't deal with speculation. I think most Americans think speculation has added energy prices. That includes people like Wilbur Ross and Goldman Sachs and others. I don't think they're ready to abolish the CFPB and put it all back to the banks. I think they have a situation now that, the analogy with regard to, and with Fannie and Freddie, they have the luxury of telling their ideological strongest supporters that they're for abolishing Fannie and Freddie and just letting it be a total free market. But the realtors and the home builders and the mortgage bankers and the lenders and everybody else know they can't do it. So they're still like the guy in the bar snarling at somebody much bigger than he, confident in the knowledge that his friends are holding him back. And if his friends were to release him, well, we saw that in the House. They became the majority in the House. Their friends let go with a coat, and now they're saying Obama won't let them do it.
The gentleman in the blue jacket.
With the LA Times, what do you hope will be the impact of the CFPB once it starts operations, and what do you think the consequences of it starting operations without a Senate-confirmed director would be?
Well, confirming without a director is a problem. I don't think it has to be Senate confirmed. I think a recess appointment does it. And again, once you've announced you're not going to confirm anybody, you can't object when people go ahead and act that way. First of all, I think you will, we don't have a lot of bad mortgages being made now because people are still a little bit shell-shocked. But I see in this opposition to the risk retention, the seeds of problems, I think a good director of the CFPB will mean that a lot fewer bad mortgages will be issued, i.e. mortgages with a very low chance of repayment. I think that would be very helpful. I think consumers will find that they are treated much more fairly. We've already seen that. The Credit Card Act that we passed, the Pew people said it's already had a very good effect and no negative effects that were predicted. So I think you will see consumers much better protected in that regard. You will also see, frankly, from the standpoint of financial institutions, some improvement. The community banks stand to benefit because their unregulated competitors will now be regulated by the same rules that regulate them, and many of them are supportive of this. That's one of the reasons why some of the community bankers have been less antagonistic than people had expected. They've already, our judgment's already been borne out. We had this terrible situation that, I don't know how it originally happened, where the Truth in Lending Act was assigned to the Federal Reserve, and the Real Estate Settlement Protections Act, Settlement Procedures Act, RESPA and TILA, was at HUD, and it was a total mix-up. Elizabeth Warren's already put those two together in a reasonable way. So there'll be less bureaucracy. Servicing requirements is the other one. I think that's a very important one. You read the testimony and people, one of the things we did was to consolidate the requirements for servicer rules in the CFPB that didn't exist. So that's systemically important. RESPA is systemically helpful, reducing red tape, making things work more efficiently, no bad mortgages, and a better shake for consumers.
The woman on the floor.
Stacey Caper with National Journal. I was just wondering, you mentioned the pushback from the ideological GOP. Where are you seeing the most pushback from the financial industry? And do you see any area where they're having any influence with the regulators?
No, one area where they're doing the most, which I think is perfectly reasonable, is to make sure they're not put at an international disadvantage. Now, they sometimes oversell that. But, there's one specific example where I think they have a good case, which is the foreign subsidiary of an American institution doing derivatives business with another foreign entity, a wholly foreign entity, not an American one, and in a situation in which the other people in that country don't have to put margin requirements on. Should they have to put margin requirements on? Well, we have to make sure the institutions, there are other things you can do. It's going to be well capitalized. I think that's a reasonable issue. I think they're trying to make sure that the Volcker rule is not done in a way that is harmful, and I think that's right. I mean, I understand in the Volcker rule, my own shorthand is that it's not either or, it's more or less. That there are some activities. We're now banning in the Volcker rule not so much the activity as the purpose of the activity, and that can be a little bit tricky. Beyond that, those are the two major ones that I have seen. I take it back. There's a third one, which the thing I've heard the most about personally is the one that confirms that we have ended the notion of a public bailout of large financial institutions. And that's nobody wants to be, some people are automatically going to be systemically important because they are banks with over 50 billion in assets, et cetera. Goldman Sachs and Wells Fargo and Bank of America too. But you have others. You have the insurance companies and mutual funds. any institution about which there is some ambiguity as to whether or not it's systemically important is lobbying not to be. We had this one hearing, and I asked 9 regulators, has anybody asked you to be covered? They said no. Has anybody asked you not to be covered? 8 of them said yes. The only one who didn't was the control of the currency, and that's because everybody under his jurisdiction is automatically covered. So I am confirmed by that it proves that being named systemically important is not an advantage, not a license to get cheaper funds as much as it is a disadvantage. That doesn't mean I agree with everybody who doesn't want to be named. Some of them should be named. But that's the other area where I've seen the most pushback.
Just to follow up on the Volcker rule, what is the concern as far as, could you explain?
Well, just that they would like to be able to keep doing what Volcker didn't want them to do. But, that one is sort of binary. The other one is this, though. The activities that the Volcker rule tells them not to do are activities which they could do if they were doing them for customers, and not if they were doing their own account. And they're saying, look, sometimes to do it for a customer, you can't just do it only for customer. You have to have a certain margin where you're doing it yourself in terms of liquidity, et cetera. And I think that's reasonable. And that's Adair Turner had said, well, look at the amount that they're doing. That's how you know. That's why Paul himself said, well, I know it when I see it. Because it's not a bright line between prohibited activities and permitted activities. It has on whose behalf are you engaging in those activities, and there's an overlap.
And can you balance that with what's in the law, or do you need to change the law?
Nobody thinks the law has to be changed to accommodate that. I mean, even people wish they hadn't been there, understand, because that was one of the things we negotiated in the conference. People understand that the statute gives the regulators the ability to do that.
Gentleman in the back.
Thanks. Vladimir Cameras with QVI. Congressman, you mentioned at the beginning that the law had some international impact in terms of other countries following the example of introducing some regulations. Could you speak a little bit about that?
Yeah, well, there are a lot of good conversations. The British are now talking about a resolution regime that looks a lot like ours, and I think we are hoping that our resolution regime is the model. Similarly on derivatives, those are both examples where I think America has moved ahead, but in a way that we think other people will join. And these are the conversations that are going on in the G20 and elsewhere. Those are 2 examples where I believe you're going to see this. And now it's interesting. The article didn't mention it exactly, but I was interested in the article in the New York Times, maybe it was Saturday, that the European Union is now going to have a union-wide consumer law. And I think that's not entirely, I don't know, they were talking about the Uniform Commercial Code as a model, but that's another example. But I would say the resolution regime and derivatives are 2 things. Now, in the resolution regime, and I had this conversation myself with Michel Barnier, and I know Secretary Geithner did, one of the things you have to do is, all right, what happens with resolution in multinational financial institutions? I think the general rule is that the host country will have the right to have its rules prevail if an American institution has to be resolved is such a nice euphemism. Dissolved is what it means. If you are going to dissolve an American institution, the foreign branches of that American institution would be covered by the American law and vice versa. And that has to be worked out, and there has to be that accommodation. Did I get that right? Yes, thank you. I just noticed my staff conferring. I thought, well, maybe yes. But it's not going to be all that easy. But the notion of, again, America's in the forefront. I mean, we tend to look domestically, but if you read about this, we are the first nation to say, hey, if you get in trouble, you're dead. And we will then worry about your mess. And we may have to minimize the mess you left behind, but if that costs us any money, it's coming from your colleagues. It's not coming out of the taxpayer. And we think that model is an attractive one. And then there is the question of derivatives, and these things are all, of course, transnational. Again, the incentive is this, and I see a huge difference in 5 years. When I became the chairman in waiting in 2006, there was this concern that all the IPOs were going overseas. Mayor Bloomberg was concerned, Senator Schumer and others. And there was this notion that other countries could benefit by attracting our financial services. And then the bottom fell out. And some of these other countries were badly damaged by practices that had happened in America. I mean, German banks were badly hit because of loose practices in the American mortgage market. And similarly, what you now have is, and I'm very struck by the difference, my choice in public policy has been more domestic, except for trying to cut military spending, et cetera, and working on the World Bank and the IMF to make them more socially responsible. But over the last 4 years, I've done a lot of international stuff, working with the EU, working with the all the international. I've met with the Japanese and Canadian and others, the European Union Parliamentary Committee on this. And there is by last year, there was, in 2009, things had shifted drastically from countries thinking, how can I lure these others, to what can we do together so none of us get hit with all this crap. And that's why I'm encouraged. And it's going forward. There's a lot of conversation.
Excuse me, Congressman, we're going to take one more question.
No, thank you. Sean Carr, Best Week Insurance News. You talked about appointments to FSOC, and of the 3 insurance-related positions, one is appointed by state regulators and is very limited in what information they can share with other regulators. Another director of the Federal Insurance Office just took office last month, and the third appointee was just nominated this month. Do you see any concerns with how the FSOC could be approaching insurance-related issues?
I thought I talked about that.
Right.
I must be particularly opaque this morning. I mean, I used to worry about repeating myself too much. Now as I said, the question was I worried about the FSOC taking too much time? And I said, in part, I asked them to slow down and not make certainly insurance-related decisions until they had an insurance representative. Yeah, I thought they went too low. Although I have to say, the state insurance commissioner should be feeling good because of the 3 appointees, all have been state insurance commissioners. Woodall not for a while, and he's been at Treasury. Michael McRaith. And very good. By the way, on the what's the guy's name from Missouri, the insurance commissioner who's on the I agreed with him when he testified. I think he's been restricted too much in what he can share with his colleagues. He is their representative, and I said at the hearing to Mr. Goldstein, I thought they were being too restrictive there. But now we have 3 very good appointees. I would hope. I would think Roy Woodall on the FSOC would be one of the least controversial appointees. I would hope he would get, as a voting member of the FSOC, confirmed right away. And the answer was, I wish the administration had moved faster. I wished I could eat more and not gain weight. I wish a lot of things. In this case, no harm, no foul, because no decisions were made adverse to or favorable to the insurance industry in the absence of those appointees. And there's a massive change in behavior. It is disruptive. Yes, we set out to disrupt a financial model that had been disastrous. We believe it is a very pro-market model, and I am confirmed by that. Nobody has pointed to any great problems. This is a pro-market model. We think in the derivatives area, putting people on exchanges, that's pro-market. I think Elizabeth Warren's stuff has been pro-market. We have no price fixing in here. All that's moving forward. And there was a lot to be done at once, complicated by the fact that they were not funded well, and that the appointment process was slow. Although, again, in fairness to the administration, when a Nobel Prize-winning economist and a bipartisan bank commissioner from North Carolina are brutally rejected by the Senate, that's part of the reason for the slowdown of the process. I wish the president had gone ahead and nominated anyway, but much more of the blame goes to the Senate confirmation process. But to go back to your question, they have appointed 3 good appointees in the insurance area, and no bad things happened as a result of the delay, and I think it'll look good going forward.
Okay. Thank you, everyone. We've actually gone over our time. I hope you've had your questions answered, and thank you for coming.